Hi, everyone. Welcome to the webinar today. We are thrilled to have you with us. We are going to be talking today about Delaware Statutory Trust. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. And before we get started, I just want to mention a couple of things. This whole thing is being recorded, so you will have access to it tomorrow in your inbox. I'm going to email it to you along with Steve's, our presenters, contact information. So if you miss anything, don't worry about it. After Steve's presentation, we'll have some time for some questions. So please put them in the question box so that we can get those questions answered. Question box is better than chat because it helps us keep track of, all the questions that are coming through and what's been answered. And before we begin, I'll give you an intro onto Steve. If you haven't heard from him before, he's been with us a couple times now. He's the Senior Vice President at Cove Capital Investments. He represents Cove Capital, and he works with 1031 exchange and direct investment clients throughout the country. Steve served for 7 years as an officer in the United States Air Force in the Special Operations community, where he led small teams as well as a large staff of hundreds of military and civilian personnel. He has served in numerous locations around the world, including multiple deployments to Afghanistan and locations throughout Africa. Though Steve has retired from active duty, he still serves in the Air Force Reserves. Prior to his military service, Steve worked in sales and marketing for multiple businesses, which included providing energy management solutions to institutional multifamily apartment owners. Today, he is a 1031 and DST expert. So we are very happy to have Steve come back to talk to this group. Steve, thank you so much for joining us and taking the time to talk to everyone today.
Yeah, thank you. Appreciate the introduction and the opportunity to speak to your audience here. We always have a good time. I always enjoy coming on these webinars. So today, it looks like we are going to go over a little bit about DSTs, specifically debt-free DSTs. Now, as Alexandra said, my name's Steve Haskell. I'm a senior vice president. I'm located in San Diego. So I live with my family and 3 little boys out in Carlsbad. And our headquarters is up in LA in Torrance. Now, I'm technically work for K Properties and Investments. So we're an advisor. We help our clients identify different types of DSTs to put into a portfolio, usually for 1031 exchanges, but also for cash investments. And we're going to go through a little bit of how that works. And our sister company is Cove Capital. So K Properties works with lots of different organizations we call sponsors. Sponsors are real estate investment firms that put together different real estate packages or syndications. In this case, we're talking about the Delaware Statutory Trust. So Cove Capital is one of those 25 to 35 different sponsor groups that we work with at any different time. And Cove Capital will have about 5 to 6 DSTs available for investment, and then make them available through K Properties to investors such as yourself, potentially. And so K Properties will have anywhere between 30 to 50 different DSTs on our platform. About 5% of them, 6%, 10% will be Cove Capital's. And with that, I'll jump right in. All right, so here's a little presentation that our marketing department put together. And just a heads up, everybody, I'm really sorry, but sometimes my camera's been going through a little bit of a wacky situation, so I may have to take myself off camera, but I can leave the presentation up. Just wanted to let you know so you're not caught off guard if I disappear. I'm not running away, I promise. All right, so now our type of real estate is what we call syndication. That's regulated by an agency called FINRA, as well as the SEC. And they want to make sure that we're taking care of investors. And so they have some regulations and caveats. And so there's things that we have to tell you. For example, they make sure that only accredited investors can invest in Delaware Statutory Trusts. An accredited investor is commonly known as somebody that makes at least $1 million, has a net worth of at least $1 million, not counting their personal residence. Another way that you can be accredited is by making $200,000 a year as an individual and $300,000 a year if you're married. Now, it's an either or situation. Now, Delaware Statutory Trust, keep in mind, is real estate. And despite what some of us in California are used to, real estate doesn't always go up. Okay. Things can happen that don't go according to plan. And the DST structure does not shelter the asset from economic conditions. So if the market tanks, well, your property might be impacted by that. But one of the benefits of DSTs is diversification. It's the ability to access high quality real estate and things like that allows you to insulate yourself potentially from that risk. You can never get rid of the risk, but you can potentially mitigate it. And that's one of the reasons people invest in DSTs, specifically debt-free DSTs, which is what we're going to talk about today. All right. So cash flows, they're not guaranteed. Past performance is not indicative of future returns. Ladies and gentlemen, when it comes down to it, you can lose money on these. You may not be suitable. Not everybody is. DSTs aren't right for anybody. Please speak to your CPA and advisors and your family before you're doing a 1031 exchange or investing in DSTs. And part of my job is not just to sell DSTs to you. My job is to help you decide whether DSTs are a suitable option for you. So a big part of my job is understanding your financial situation, where you're coming from, what your objectives are, what your criteria is for investments, and seeing if I have opportunities that can match that and satisfy those goals and objectives. And you know what? Sometimes I can't. And that's okay. If you have the information to make a decision for you and your family, whether DSTs are right or not for you, and you decide that they're not, well, I feel I did my job. You have the information you need, you're educated, and you went a different direction. Hopefully I can earn your business in the future, or you have someone else that you know that you can refer over to me. So you'll have my contact information at the end, but just in case, go ahead and write down. It's Steve, Steve, at KPI1031.com. And KPI is like Kilo Papa India. KPI1031.com. And buckle up, ladies and gentlemen. Here we go. Straight from Cove Capital's marketing department, we are different. We are debt-free. This is a contrarian approach to most real estate investments. We believe our strategy is highly prudent considering the recent pandemic conditions of the U.S. economy and current state of geopolitical global affairs. Now, it's kind of funny reading this, but in all actuality, this is true. One of the greatest things about real estate, and this is going to sound kind of like I'm selling against myself right now, but one of the greatest things about real estate that most people will tell you is that it's so easy to get financing, and real estate, relatively speaking, is a highly predictable asset class compared to maybe some others like stocks and things like that. So you can get competitive financing for it, buy it, and on a very tangible asset that is relatively predictable, and also that you can feel and live in, and things like that. So it's usually across the board, it's common sense to leverage up to buy real estate. And that's been the common theme. And there's reason to believe that. And there's reason to think that way. It's a strong thesis. However, just to add to that, I mean, if you want to get rich as well, I mean, you have to lever up in real estate typically, unless you're just given a bunch of money. So one of the best ways, historically speaking, to get rich is to leverage up and buy real estate. Take advantage of the tax efficiencies, pay it down using other people's money, using the rents, and then leverage out the equity, go buy something else. It's great. However, it's a different thesis if you're trying to stay wealthy. And that's our clients typically. They made their money. They did a good job. Ladies and gentlemen, if you're listening to this webinar right now, most likely you were participating in the best real estate market run that this country has ever seen. Congratulations. That's awesome. Most likely use leverage at least some point to get you to the place that you are today. Smart, good on you. But many of you are now, and many of my clients are now transitioning and thinking, well, I made my wealth. Now I want to stay wealthy. I want to preserve my capital, right? I want to keep my legacy. I want to preserve my standard of living. I want to retire. And so you want to shed a lot of that risk that debt provides, or that's just intrinsic with debt. And we're going to go through some of those things. There are things like balloon loans, foreclosure risk, cross collateralization, cash flow sweeps, and lots of issues that comes with commercial properties and net lease when it comes to debt that you may not know about. Prepayment penalties, defeasance, yield maintenance, all these things can eat into your principal and cause you to lose the wealth that you've waited and worked so hard for over the last decades. Here we go. A little bit more about Cove Capital. So at this point, about 1.5 million square feet of real estate, 380 million transactions and 70 properties. So Cove Capital was founded by Dwight and Kay and Shay Lappin. Dwight Kay is the founder of Kay Properties, the company I work for. He started off back in the 2008 recession. Before that, he worked for other advisors and brokers like ourselves at Kay Properties. And before that, he worked for as an analyst and broker in the real estate market. So as he worked up through Kay Properties, or started building out Kay Properties, he noticed that a lot of his clients were survivors of the 2008 crash. And they still remember the pain from that 2008 that they went through, and they didn't want to go through it again. And many of them remember the day they wrote the bank the last check for that mortgage that they paid off on their investment properties. Unfortunately, the majority of the DST market were all leveraged. All the DSTs, except for maybe one or two, almost all of them had mortgages on their properties. So what Dwight, the owner, and Shay Lappin, now president of Kay Properties, decided to do was to work with other sponsors to develop custom DSTs for Kay Properties clients that did not have mortgages. Well, the demand outpaced supply, and they just couldn't keep these DSTs on the shelves because so many clients did not want to risk losing their properties. And they remember 2008. They know that 2008 can happen again potentially someday, and they just want to live off the cash flow, the income, retire. They don't want to take on that risk. But Dwight and Shay could not create and provide enough product to their clients. So they went and they started Cove Capital, a sponsor group that specifically focuses on debt-free DSTs. And now we have some funds and LLCs as well, but mostly DST properties. Here's a little bit more about Cove Capital. All right, here are some of the tenants that Cove Capital purchases in their commercial properties. So they have multifamily, they have industrial, they have medical, they have some shopping centers. But as far as the net lease type properties, they like to stick to big credit tenants with bond ratings, publicly traded, with very low probability of going bankrupt. And that's really that preservation of capital and risk mitigation is Cove Capital's primary focus. So to get everybody on the same page, we're going to go briefly over 1031 exchanges. I know this is mostly talking about debt-free, but I just want to make sure that everyone knows what 1031 exchange is. So 1031 exchange is when, and I'm just going to run through this. So everybody forgive me if I'm not going directly on script with the slides, but I want to focus on what's important today, which is the importance of going debt-free. All right, in a 1031 exchange, what it does is it allows you, the IRS has provided a code in which it allows you to sell a property, used for investment or business purposes, and replace it with another property, usually called like kind, and not have to realize any gain or loss on the property. You defer your tax consequence. There's some rules. You must use a qualified intermediary. You must reinvest 100% of the net sales proceeds. So whatever you sell, the cash goes into the account of the qualified intermediary, number one on this sheet here. And you must use all of that cash. You can't touch any of it. You can't take it out. You must use all of it and put it into a replacement property. That property that you purchase must be valued equal or greater than the net sales price of the property you sold. And the property that you buy must be identified within 45 days of the closing of your original property. And you just must purchase that identified property within 180 days. And number 4 and number 5, the 45-day rule and the 180-day rule, they run concurrent, okay? So if you have questions about that, please give me a call, shoot me an email. Happy to go over it with you in detail. But right now, that's not the main focus of this call. Here's a little illustration of how those times run concurrent. Okay, important note. Many people think, hey, I'm selling this single family rental that I have had for 20 years. In order to buy a like-kind property, do I have to buy another single family rental? The answer, ladies and gentlemen, is no. You would be absolutely wrong if you said that. And you can use that property, sell it, exchange into medical. You can buy raw land, industrial, self-storage, multifamily, as long as it's held for business or investment purposes. And the same goes with the Delaware Statutory Trust. Now, the Delaware Statutory Trust, here we go. Let's see here. All right. I'm kind of keeping up with the slides today. Delaware Statutory Trust, ladies and gentlemen, is just an entity. It's a wrapper on a property. And it's much like an LLC or a family trust. Many states have them. California Statutory Trust, Nevada Statutory Trust. But for some reason, Delaware gets special privileges. And the IRS has made a ruling that whatever property a Delaware Statutory Trust holds entitled to can be considered like kind, as long as it's considered business or investment purposes. So people can sell their property, that single family house, and buy a piece of a trust that holds title to one or many properties. Now, those properties can also have leverage, which we'll get into. Sorry, guys. Let me catch up here. All right. Here we go. So those properties can have varying levels of leverage that I'm going to talk about as well, that you can use for your 1031 exchange. But let's just make sure I went over all these. Let me check my notes, make sure I'm covering everything. Okay, here we go. Right on cue. So now when you buy a DST, you're going to get a percentage ownership of that property. And so you can take $131,456 property that you just sold, and we can put that exact amount of money into a DST that will get you a percentage ownership. So it doesn't have to be in $100,000 chunks or $200,000 chunks. We can go down to the dollar and make sure that you're buying the exact amount of property that you need to purchase to satisfy your 1031 exchange requirements. That's why it's so easy. It's turnkey. And so many investors are flooding to the DST market right now. So another interesting thing about DSTs that's different than some other syndications, such as LLCs, partnerships, or REITs, is that investors receive 100% of their pro rata share of the rents from the property and the appreciation, if there is appreciation on the property, right? So, and of course, net of fees. So unlike DSTs, partnerships, LLCs, and REITs, which are other similar syndications that you may be aware of, the sponsor is typically allowed to share in the upside. So you may have heard of a waterfall fee. Now, a waterfall fee happens like some of our funds that we have, where there might be a 10% preferred return. What that means is the investors get back 10% return Then anything above that, the sponsor can maybe take 30% or 40% or 50% of the upside beyond that 10%. Sometimes it's less, sometimes it's 8%, sometimes it's 6% preferred return. But whatever it is, sponsors often incentivize themselves and make money off of the overall return. DSTs do not allow that. The investor must be entitled to 100% of the upside on their investment. So if the property goes up 500%, well, the investors are entitled to all of that appreciation, net of sales expenses. Okay, now, also unlike LLCs and REITs, a DST allows you to 1031 exchange both in and out of that entity. So when our clients work with us, we don't disappear. We work at the single point of contact for our investors because we want them to reinvest with us, because when that DST sells, well, they can 1031 exchange and they can go into another DST. They can go into their own property. They can pay taxes or do a hybrid of all three. And we're here to help them with that. They should always speak to their CPA, but with the guidance of the CPA, we help coordinate those transactions for them. So why do people invest in DSTs besides all the nice little IRS benefits that we just mentioned? Well, they're completely passive. So DSTs have built-in property management. Here's a big one. All right. No, I want to cover this. So the properties are already closed and cash flowing. So our clients are buying pieces of a trust that the sponsor already owns. So what does that mean? And why do you care? Well, what that means is when an investor buys a piece of that trust, they can close on that property in 3 to 5 business days and then start accruing revenue right away. So when that DST is made, the sponsor is making all of the revenue. The rent's flowing up from the property through the trust and into the bank account of the sponsor. Now they go to people like K Properties and say, hey, K Properties, will you please show us to your clients as a potential investment option? We do due diligence. We look through. If it's approved, we will show it as one of many options to our clients of whom it's appropriate. And our clients, if they choose to use that DST for their portfolio, will 1031 exchange or invest cash and buy, say, 1%. So that sponsor goes from owning 100% to only owning 99%. That investor buys 1% of that, then immediately starts generating revenue upon closure. Typically, the first distribution goes out the following month as a pro rata distribution for the remaining month of that initial month of ownership. So it's not like the old TIC days, tenants in common, where the sponsor has to line up all the investors, pick a property they want to close on, then all the investors close on the property all at once. That's not the case. There's a lot of closing risk there. What if things don't work out? What if something weird pops up in due diligence? What if the seller goes crazy and decides not to sell the property? You can blow the exchange for the entire investor base. All those people lining up with their money in the qualified intermediary, waiting to close on that property. That's terrifying. Well, in DSTs, that's not the case. These properties are closed, stabilized, ready for investors. No closing risk. All right. That's big. And also keep in mind, as long as there's no bridge loans or anything like that on the property, if just one investor comes in, that could be okay. It'll just be that one investor and the sponsor holding ownership of that trust, making all the potential revenue from the property, and they will just hold it till they sell it. Okay. You don't have to wait for other investors to come in to that DST. All right. So that's long story short, it's a turnkey 1031 option. Number 2 mentioned, it's already built in with professional management, typically large institutions, a lot of times national level institutions that are managing your properties for you. And so number 3 and 4 are kind of the same here. It's basically, it's DSTs. The biggest benefit of them is it allows real estate owners and managers to finally retire. Okay. Many people, they want to go travel. They want to spend more time doing the things they love with the people whom they love, and they're tied to their properties. Holidays, they're getting calls in the middle of the night on Christmas, Thanksgiving, whenever. They can't get away because they're tied to these real estate that and their tenants, and they don't know what to do. If they sell the property, they get hit with a huge, up to potentially 40% property tax, or excuse me, not just property tax. It's a state and federal income tax, capital gains tax. It's a recapture of depreciation tax. It's the Obamacare tax. All right. When you start layering that up, it comes out to be a pretty significant expense. And so they say, well, I should 1031. But if I 1031, I'm not really getting rid of the problem, because it'll just be a new problem, a new piece of real estate that I have to learn. I have to get familiar with, and I have to learn how to manage, or I have to move in property managers and work with all that. And then I have to manage the managers at that point. Well, the DST may be a good solution for folks that don't want to go down that route. Typical 1031 investment is 100,000. And once again, DSTs, you don't have to put all your eggs in one basket. If you have $500,000, maybe put $100,000 into a Walmart in Texas, $100,000 into a multifamily 200 or 350 unit building in Florida, and then maybe an industrial park in Ohio and a self-storage in North Carolina. And you can diversify your money by asset class, asset type, geography, and sponsor. Also, and I think this is my major segue, ladies and gentlemen, which everybody came to hear about, is number 4 and number 5. They have the option to go in debt-free properties or leveraged DSTs. All right, but sorry for the false alarm, everybody. Don't mean to let you down by one item before we move on. Many of you are wondering, hey, what type of tax reporting do I get on this? Is it a K1? No, it's not a K1. K1s are for LLCs and partnerships and things like that. DSTs provide a substitute 1099 and often a grantor letter. May look similar to the ones that your property managers provide you, and it goes on the Schedule E of your tax return. All right. So I'm going to kind of start. Let's see, how are we doing on time? All right, good. We got about 20 minutes to go. That gives me plenty of time to start going into debt. However, I'm going to start focusing more on the debt and debt-free component. So I'm going to appropriate the angle of these slides to kind of focus more on that. So the DSTs are prepackaged, right? And which makes them very convenient for 1031 buyers. Now, many of you are saying or thinking right now, well, I have leverage on my property. I have a mortgage, and I'm selling a property for, say, $500,000 and at $100,000 mortgage on it. So I have $400,000 sitting in the qualified intermediary account. So what do I do if I want to invest that in DSTs? I only have $400,000. I need to buy $500,000. Well, Delaware statutory trust properties have built-in loans, many of them, and they're varying levels. So some of these properties, maybe half of them were bought with a mortgage and half were bought with cash. Or maybe they're 30% leveraged, meaning 70% was bought with cash and 30% was bought with a mortgage. Okay, so listen up, because this part's a little bit tricky. If you have a 50% leverage DST and you put $100,000 into that DST, you're getting yourself $100,000 of equity, $100,000 of debt, and you just bought $200,000 of property. So with $100,000, you bought $200,000 of property with a 50% leverage DST. Okay. So pop quiz. You sold a $500,000 property. You have $400,000 sitting in a qualified intermediary account. how much money of that $400,000 would you need to invest in a 50% leveraged DST to get yourself $100,000 of debt? Answer is, ladies and gentlemen, $100,000, and the rest can be invested in debt-free DSTs. So you have $400,000 sitting in there, right? Use one of that $400,000. So $100,000, put that into a 50% leverage DST. You just bought yourself $200,000 worth of property, put the other $300,000 into debt-free DSTs. Okay. That just bought you $500,000 of property. Give me a call if I didn't do a good job explaining that. Shoot me an email. I'll repeat myself 1,000 different ways to make sure I communicate it effectively to you. Some people hear it differently, and sometimes I just do a bad job communicating it. I don't always know which one it is. And so I have my good days and bad days. So let's go over it one-on-one if you'd like to go into it further. Now, the great thing about DSTs with debt, and I know this is about the dangers of debt, but I want to talk about the good things first, is it's built in and it's qualified non-recourse debt, which means you don't sign for it. You don't apply for it. It doesn't show up on your tax return. In fact, I've had clients that have large real estate portfolios and they want to go buy a property on their own. The bank tells them, I'm not going to give you a loan. You're too leveraged in your portfolio. So that client comes to me and he says, hey, Steve, I'm going to sell one of my properties that's leveraged, 1031 exchange into a DST that's leveraged. And then the bank will give me a loan to go buy another property. Now, theoretically, he has the same amount of leverage or even risk to foreclosure risk and debt in his real estate portfolio as he had before. But for some reason, the bank doesn't see it that way. And so they lent to him. All right. So I'm not saying that'll happen every time or that'll happen to you, but I'm just saying I have had clients that have worked it that way. And it's just kind of gives testimony to the non-recourse nature of the loans, and which also means that the bank can't come after you personally. Okay. It's the property's held as collateral in a DST. You can lose your property though. So keep that in mind. All right. So talk about number two, they're prepackaged, already closed on. And it typically takes 3 to 5 business days to close on these properties. Okay. Loan to values. So we already talked a little bit about these loan to values. Now, I want to talk about the benefits of going debt free. All right, let's see. I want to make sure that let's get through all this now. All right, different types of properties. You have to be accredited to buy DST. Okay. All right, here we go. This is what we really want to talk about. All right, first of all, no refinancing risk. So here's something to look out for everybody. Right now, you've got a lot of folks out there that have leveraged properties that have balloon loans on them. What a balloon loan is at a point in time when the entirety of a loan is due. So a lot of institutional real estate will have a loan that's either interest only or let's say 30-year amortizing. So it amortizes on a 30-year schedule, but will be due at year 10. So you have to pay the entirety at year 10. Well, so you have two options at that point for those that own properties that have that kind of financing. You either sell the property or you refinance. Now, there's a lot of syndications out there and a lot of REITs that locked in loans with very low interest rate world, 2-3% interest rates. And then they've got a lot of financing that's coming due. And they'll be walking into balloon loans that they'll have to refinance at a 6% interest rate. So the predictability of your income is going way down. And most likely, those distributions are going to have to be cut significantly. Probably won't lose the property if they held the property for a significant amount of time. But for a lot of folks out there, they may not meet what we call a debt service coverage ratio. That means as interest rates go up, your expenses go up, and the number of times that revenue on the property can pay down that interest expense will go down. So when they can't, when that property doesn't meet a certain debt service coverage ratio, the bank can do what's called a cash flow sweep, which is number 6 on here. And in a cash flow sweep, the bank is going to collect all of the revenue from the property and put it in a lockbox that you don't have access to. And they're going to protect it and keep it in that lockbox until that property's debt service coverage ratio comes up over a certain threshold. And at that point, theoretically, if the property recovers and everything's okay, excuse me, the bank will release those funds back to the investor. Okay, so DSTs, it's just real estate. So remember, it's no different. All right, and so they could have cash flow sweeps built in. And I'm going to talk a little bit more about cash flow sweeps in a little bit. All right, so number 2, going debt-free eliminates the risk of when you 1031 exchange and have to purchase property of equal or greater value. So a lot of folks that I've talked to in the past, they are debt-free. They don't have a mortgage on their 1031 exchange, but they're talked into going into a property with leverage because, I mean, they increase their upside potential. And there's also tax efficiencies. You go into a property with more debt than you originally had, or you buy a DST and use debt to buy more property. Well, you potentially expand your basis, can depreciate more because in a DST, you can continue to depreciate and get some tax efficiencies potentially. And there's some benefit there. And so they find that enticing. And so they take on additional leverage that they don't necessarily need for their 1031 exchange. The problem with that, oops, my camera's doing that thing. 1 second, everybody. Let me stop video. Oops.
All right, folks. Steve, if you want, we could stay off camera. If you can't get it to come back on, we can go ahead and just because we could see your screen. Okay.
Okay, good.
Yeah.
Still logged in and everything. Sorry about that. Everything kind of just crashed in the background, so I'm trying to pull stuff back up. But you can still see my screen?
Yep, we can see it. We can hear you. So we'll just do
beautiful.
no video.
All right, good deal. So we'll just go back to where we were here. Yeah, sorry about that, everybody. Let me find where we are here. Okay, there we go. All right, we'll go no video. So going back to 1031 exchanges, I think that's where I was. So in a 1031 exchange, because you have to purchase property of equal or greater value, by taking on debt, you're buying more property. So you really have to stay in debt on your future exchanges. You can't go back to being debt free unless you want to replace that debt with cash. And very rarely do people want to do that. So just keep in mind that if you do take on debt in a 1031 exchange, whether it's on your own or in a DST, that when you 1031 exchange, you're going to have to stay in debt, most likely, in order to purchase property of equal or greater value. So next, that's good. It covers that. So number 3, provides 1031 investors the ability to diversify a portion of their exchange dollars in all cash debt-free property in an effort to reduce potential risk. So I remember that scenario that I had a little bit earlier where you had $500,000 sales price and $100,000 of debt. Well, if you were going to replace that entire property into another, say, triple net property that you bought on your own, and you had $100,000 mortgage on that property, well, if that tenant goes bankrupt, your bank could potentially foreclose on your asset if you don't pay it off. Excuse me. Or it can force you to fire sell that property to pay back the loan. And so that impacts your entire investment. But in DSTs, you can diversify. So only a piece of your exchange, only a piece of your portfolio is exposed to that foreclosure risk. And in this case, it was $100,000 out of the $400,000 in cash that you're exposing to foreclosure risk, where the other $300,000 went into debt-free DSTs. Okay, now number 4, flexibility to hold through any potential market downturn, credit crunches, recessions, and or depression. So there's a saying that time heals all wounds in real estate. And I think there is some truth to that, but not if you have debt. If you have debt and your property goes through a hard time, your bank can force you into a foreclosure situation or to fire sell the asset. And you can't really recover from that. So if you're debt free, on the other hand, you don't have to worry about debt service coverage ratios and cash flow sweeps. You don't have to worry about the bank forcing you to decide on who the tenant can be. So what a lot of people don't know, especially a lot of triple net brokers won't tell you, is that the bank has a tremendous amount of control of your triple net property if you have a loan. So when I say triple net, ladies and gentlemen, I mean things like Walgreens, O'Reilly's, CVS's, FedEx, these commercial properties. And what happens is when a bank has a loan on it, they can decide who your tenant is at times. So if you have a Walgreens in there, or if you have a very strong tenant of FedEx and they leave, your bank may not let you put a Piggly Wiggly in that building. They may say, nope, you have to go find another tenant as good as in credit as FedEx to replace the current tenant, because I loaned you cash to buy a building that had FedEx in there. So you better go find a Walmart or an Amazon to replace that building, or else I'm going to foreclose. And in the meantime, you have to continue to pay this cash flow to me. You have to continue to pay your debt expense. Oh, and also, let's just say if FedEx is still paying the lease on the building, but they just let it go dark, meaning they leave the building but still pay the rent because they're legally obligated. Well, the bank may still do number 6, a cash flow sweep. So they still may lockbox that money and not let you see it. So in a worst case scenario, the way that looks is you have FedEx and there, your triple net broker says, oh, FedEx, they're not going to go bankrupt. They're one of the biggest companies in the world. They move 30% of the U.S. government's GDP approximately on their trucks and on their planes. You're going to be just fine. Oh, okay. 10-year lease. You're good to go. Oh, okay. That sounds nice. Yeah. Triple nets are completely passive turnkey mailbox money. All right. I'll do it. But I'll need a loan because, they're expensive, $20 million. So, okay. Take out a loan, buy the property. And then FedEx says, hey, you know what? We're not going to work here anymore. We like the location. We appreciate it. We're still going to pay you the rent, but we're growing quickly. And so we need a little bit bigger place. We're going to go down the street. And so we'll see you later, but we'll still pay the rent. You're just like, oh, well, okay. At least they're going to pay the rent. So I think we're okay. Well, then the bank is going to come back and say, yeah, they're still paying the rent, but we're going to take that and we're going to put it in our lockbox and hold on to that to protect ourselves. Well, shoot. Okay. Well, I guess I have to go find another tenant then. So you head out, you go find yourself another tenant, you bring in that Piggly Wiggly and put it in there. You say, hey, Bank of America, I found myself another tenant. We're re-tenanted, and they're going to give me even more cash flow. FedEx was paying me 5. Piggly Wiggly's going to pay me 6. Well, they're going to come back and they're going to say, you know what? They may be paying you 6, but I lent you money to buy a FedEx building, not a Piggly Wiggly building. So go pound rocks and find me an Amazon or a Walmart. Well, if you can't find yourself an Amazon and a Walmart, by the time your balloon loan is due, then you're probably gonna be foreclosed on there. So, and guess what? That rent has been lockboxed in the cash flow sweep the whole time. So you're probably never going to see that again either. So be careful, ladies and gentlemen. Like I said, my job is to educate you on the risks and all the potential ways you could lose money to determine whether, different options are the right options for you and your family. I'm really not here to tell you everything is perfect and rainbows, okay? Especially, we're not too optimistic about the upcoming market. So some of these issues can become real realities, right? And I want to make sure my clients are ready for it. And so that's what I'm doing here today. All right. So number 5, cross-collateralization. So there's some sponsors out there that have portfolios, and portfolios are great, for the right folks, which is one DST that may have 5, 6, or 26 properties in that DST. Now, that what they'll say is a lot of times is, hey, investors, put all of your exchange into my DST. You just get one 1099. So administratively, it's easier for you. You can just put on the schedule your taxes really easily. And you're already diversified in 11 different states. And you have lots of different properties. So you don't need to go into other DSTs. Well, what they don't tell you is that there's one loan on it and it's cross-collateralized, meaning that maybe only a small portion, maybe only a few properties are struggling, and the rest of your properties are doing fantastic. Well, that's okay. You went into this DST because you know that real estate doesn't always go up. You know that some properties may struggle, but it'll be flattened out with how well the other properties do, and which creates steady, still steadies out your income. That's the whole point of diversification. Well, that cross-collateralized loan kind of throws a wrench in everything, because that bank comes in and does a what? Number 6, cash flow sweep, because the debt service coverage ratio on those properties or on the portfolio dropped under a certain level because you have some problem children in that portfolio. So even though your principal may still be pretty strong, your cash flow could take a huge hit due to the cash flow sweep, because the loan was cross-collateralized all over across the entire portfolio. So even though a small portion of your portfolio is struggling, the bank is going to sweep the revenue from the entirety of the portfolio until those problem children come back around. Moving on. So oftentimes all cash debt-free DSTs can provide higher cash flow than leveraged DSTs. So that wasn't really the case very often until this last 8 months or so, when the Fed continued to jack up the interest rates in a pretty rapid pace, and it actually outran and eclipsed cap rates. So now cap rates will stay at around 5% or so, and then you have interest rates at 6%. Well, you're in a negative arbitrage situation, and the cash flow is actually less on leveraged properties than they are on debt-free properties. All right. It used to be that cap rates were higher than interest rates. So the more loan you took on, the higher cash on cash return you could get. Not really the case anymore, at least at the moment. Okay, number 8, allows investors to protect themselves from financial catastrophe of a complete loss of their principal due to lender foreclosure. Covered that. Number 9, balloon mortgages. Covered that. Number 10, no lender prepayment penalties or defeasance costs. So this one really comes into play, and I've seen it be a headache for investors and even DST investors, When you have an unsolicited buyer come along in 2 years into the DST and say, hey, this market's hot. I'm in a 1031 exchange. I need to buy something quick. I love this property. I'll pay you $1.40 on the dollar for it. Well, that's great. The problem is my bank is going to charge huge prepayment penalties, defeasance, and yield maintenance if I sell within the first few years. So that may require you to pass up on that amazing opportunity to sell to a real needy buyer. Okay. So when you're debt free, you don't have all those penalties, defeasance, yield maintenance to worry about. So if an unsolicited buyer or an opportunity comes along for you to sell that asset for a nice pop in return, well, you can take advantage of it. All right. So a little Cove Capital overview. We have properties that are in different states all over the United States. We have a medical, net lease, industrial, self-storage, or just, no, I don't think Cove has self-storage right now, but they have shopping centers that are doing real well at the moment. Yeah. Some of the tenants we already went over. Some of the nice things people are saying about Cove Capital. Okay. Let's see. And we are right on time, Alexandra. Here are some examples of the properties, but why don't you give me a call, shoot me an email. We can go over some of these in person. And yeah, I'd love to be a resource for you. Over to you, Alexandra.
Yeah, thank you so much for the presentation. I am going to launch a poll question for you all on here. I know Steve just went over those properties really fast, but if you do want to be sent like a whole listings of all of the debt-free 1031 exchange properties, if you say yes, we'll send you over a list for you to review. Oh, your camera's back. Yay. So I'll leave that up for just a few minutes. And then also we did have some questions already come in. If you have questions, please put them in the question box. Question here from another fellow Steve. Capital gains consequences of selling an all cash deal and replacing it with a leveraged DST. If I cash out after DST holding period life cycle, in contrast to rolling over to another DST.
Okay, so the first question was, if you have debt and you decide to go into debt-free DSTs, what's the potential tax consequence?
Exactly.
Okay.
Yes.
Good question. So you have to go back to the IRS requirements in which you have to purchase property of equal or greater value. So let's say you sell for $500,000 and you have a $100,000 loan, and then so that means there's $400,000 in cash that you have in your qualified intermediary account. You have basically three different options. Your first option is to take on a mortgage to get back to 500. Your second option, which is the one that you're referring to, is go take that 400, put it into debt-free options. You will have a prorated tax consequence potentially on the 100,000. So that income, capital gains, recaptured depreciation, Obamacare tax. So you could potentially have to pay that on what we call boot, which would be that $100,000 piece. Now, please speak with your CPA. You may be able to net certain gains and things like that against losses elsewhere in your portfolio, or your CPA may be able to do some fancy footwork in order to mitigate those tax consequences. But if all else held equal, and if you don't have those opportunities available to you, just expect to pay a prorated tax consequence on that $100,000 boot. Now, third, you can add cash. So in that case, you had $400,000 in your qualified intermediary account. You can add $100,000 of cash to your exchange to make it completely debt-free. So those are the three options available to you.
Okay. Good explanation there. That makes sense. Another question, a couple questions more from Steve's son. Who are the top 5 or 10 DST sponsors by market share? And then he had a follow-up about, any recommendations for qualified intermediaries.
Good question. So This webinar is sponsored by Cove Capital, right? Which is a sponsor. So if you call me up and you say, hey, Steve, I want to work with you in K Properties, I don't care who you go into. I don't care if you use Cove or not, right? Now, I love Cove because they're a sister company. I don't get any special benefits or pay or anything like that putting people into Cove Capital, but they are debt free. And on my clients, they've done extra effort. For example, I haven't seen a sponsor, excuse me, pay out of their own pocket during COVID to make sure that investors were made right on their distributions. I saw Cove Capital, I saw Dwight and Shay actually pay investors out of their own pocket so they did not miss any distributions during COVID when
Wow.
the rent moratoriums took place. I haven't seen any other sponsors do that. So in that sense, I do have a predilection towards Cove there. But other than that, I just want to make sure these are right for you. However, on this call, since it's Cove sponsored, I don't want to kind of bring up any
Mhm.
other sponsors, but
Of course.
call me. I will give you a rack and stack of the different sponsors, what I think they're good at, where I've seen them struggle, and then kind of give you the ins and outs to help you decide which ones are best for you.
Yeah, and I can say, at least firsthand from our members telling me that they are very happy with Cove and the customer service that they get. That's definitely something I've heard. So that's just my 2 cents. And then what about a qualified intermediary? Like, how do you go about choosing one? And or does K Properties or Cove Capital put you in touch with the qualified intermediary?
Yeah, also a good question. So there's the biggest ones in the industry, right? So there's the IPXs
Mhm.
and those and asset preservations that are backed by big title companies and things like that. You'll find them all over the country, basically. And so they are a brand that you can recognize. They're bonded, insured, everything. So you can feel comfortable with them. Now, you have different things to think about. Customer service, if that's more important to you and you are comfortable with a small firm that has good customer service, I can recommend some of those that my clients have given me good feedback on. And once again, shoot me an email and
Yeah.
say, hey, Steve, send me some qualified intermediaries that you like, and I'll send you a handful that my clients have given me very positive feedback on. And I'll say, hey, these guys are really big. They're the gold standards. These guys are in the middle market, good size, have a few different branches all over the country. And this guy, he's the smallest, pretty much a 3-man shop, but I've never seen customer service as good as these guys provide. So I'll give you a little Goldilocks selection that you can choose from.
Great. Yeah. And I put Steve's email in the chat. I'll also email it to everyone tomorrow at the recording. So you'll have plenty of opportunity to get in touch with him. I just launched a poll question for a complimentary consultation. If you want to take advantage of that, I can connect you with someone over at the Cove or K team. I don't know if you take those, Steve, but you'll get in touch with someone if you say yes to that question.
Yep.
Another Steve, a different Steve. We have a lot of Steves today.
Oh my
Steve-
gosh. Yeah, there's a certain like couple of decades where I'm pretty sure 1 in 5 kids were named Steve. In my high school football team, I think I had 6 Steves and 2 of them were coaches. So
That's funny. I also come from a generation of a lot of Alexandras and have met many. So I get it. Steve, a different Steve, what is the approximate cost or percentage of exchange in and then exchange out? So what's the cost?
yeah, so each DST is going to be different. And each DST comes with a private placement memorandum that is going to line item all of the different fees that are in there. And part of it, most of it is your typical real estate fees. So things like what it costs to buy the property, the due diligence, and the things like that. What I would look out for, as well is there's not necessarily look out for, but just to be aware of, is the syndication fees is what's going to be the premium that is maybe more expensive than if you were to buy the property on your own. And that's going to be like my company's commission and the marketing fees and the fees to file it with the FINRA and the broker dealers and all that. And so that's going to be a few percent on top of it. So yeah, if you call us, part of my job is to walk you through each DST and to show you where the fees are and just bring them up to you and make sure that you feel comfortable that this property is going to be able to appreciate and overcome those fees. That's part of the thing with any real estate, but specifically with DSTs and syndicated real estate in general. And so another nice thing about debt free is you don't have a loan on that property. So you can hold it as long as you need to hold it. And you don't have a balloon, which is a ticking time clock at year 10, where you need to sell it. So a lot of times, yeah, there's fees. So we need to make sure they make sense. But on debt free, you just have to realize, hey, is the cash flow, is potential cash flow something that you're comfortable with? And are you comfortable being in this this DST for a long period of time? And at that sense, you know, the fees aren't as big of a deal as one with debt.
Yeah, absolutely. Especially over spread out many years, it makes sense. And you are paying in the sense for the convenience and the passive, you know, nature.
The lifestyle.
Yeah. I mean, like, what do you want, right? I mean, if you want to hoard every little penny from an investment, then that's going to take a lot more time and work on your end versus having someone else do it for you. So there's a cost to it. Absolutely. And it may or may not be worth it for some investors. So
well said.
Yeah. Liz asking, what are your ROI rates these days for multifamily and retail?
Yeah, good question. So with multifamily, we really haven't seen the cap rates come down too much. I think sellers just don't need to sell right now for the big part of it. So the supply is low still, especially at this level of assets. I think that's going to change, and it already has started to tip. So we have seen cap rates expand a little bit. The problem is interest rates have gone up faster than cap rates have gone up, at least right now. So cash flows on properties with debt kind of are sticking around what we're used to, you know, between 3.5% and 4.5%, I would say. Now, commercial assets are different. Commercial assets, we have seen more of an expansion in cap rates. And excuse me, I think part of that is because banks don't want to lend on a lot of these assets between 20 and $40 million. And so that are commercial assets, they're a little scared. And so prices have dropped. And so organizations like Cove are able to scoop them up with cash and take advantage of those cap rates, the cap rate expansion there. So I would say we're seeing up north of potentially 6% on those.
Okay. Also, another Steve asking about UPREITs.
Are you serious?
So are there UPREITs, like, do you have any information about how that plays into an investment strategy? I know that's not necessarily your niche, but any comments there?
You know what? It's rapidly, I should say, becoming our niche.
Okay.
Yeah. So 721 UPREIT. Basically, that's another IRS, I don't know, section in the code in which allows REITs to purchase a property. And when they do so, they have the option to offer the seller of that property ownership in the REIT in exchange for their property. So, and that is tax deferred, a tax deferred transaction. So the way that looks in a DST is a REIT would come buy the property in the DST and offer the DST investors operating units in their REIT in exchange for their ownership in the DST. And that's a tax deferred exchange. And so the investors in the DST can go up into the REIT and be ultra diversified in that REIT, have access to institutional grade real estate, and get a lot of the benefits from that. The downfall or the risks, caveats, is that you're now married to that REIT. If you cannot 1031 exchange out of a REIT. So if you want to get out, you're going to have to pay taxes at that time. Theoretically, you can control your tax consequence with the additional liquidity by just selling off pieces, right? Instead of you have $1 million that goes up into the REIT, you may just take out $20,000, $35,000 at a time. And then maybe you have losses that year and you can net your losses against your gains that are being held in that REIT. So that's a potential benefit. However, like I tell all of my investors, say, hey, let's look through. This may be a good strategy for you. Let's look at the DSTs that are using the 721 UPREIT as a strategy. But keep in mind, a lot of these benefits aren't guaranteed, such as liquidity. We're seeing a lot of REITs like I think Cantor did it, KKR, and some of these others. I think BlackRock recently, they decided that they're going to shut down their liquidation features in their REITs. So a lot of folks that were planning on getting their cash out aren't allowed to anymore. So there's a difference between a private REIT and a public REIT and things like that. So all those items we need to go through. So if doing a 721 target is something that you're interested in, then there's definitely 2 to 3 layers of additional due diligence that we'd have to do together to see if that's the right decision for you.
Very interesting. I actually was not aware of that. So, that's really, I guess it's really telling of our current housing market. So that makes sense. Yolanda asking, and, this might be a good review. I showed up a few minutes late. Can you tell me how the DST differs from the 1031 exchange?
How the DST differs from the 1031 exchange. Got it. So 1031 exchange is an IRS, a section in the IRS code that allows you to defer your taxes. A DST is an option that you can use for a 1031. So 1031 is is a transaction process. A DST is an investment option. So you sell your property, do a 1031 exchange, and then invest that money potentially into a DST, which can potentially satisfy those 1031 exchange requirements.
Well said. Well said. And we'll end it there. I don't see any other questions that have come through, but I think this is a really great option for someone who wants to do a 1031 exchange, especially now. But of course, talking to someone about it like Steve is probably the best way to find out if it truly is a good fit for you. Not everything is always going to be good for everyone, but I think it really helps to talk to someone who knows what they're doing. It doesn't ever hurt, I think, to learn what's possible, or learn what's maybe not. So that's a good thing too. And I really thank you, Steve, for providing that for everyone here on the call and making yourself so available. I will definitely be sending everyone your email and make sure that, everyone has an opportunity to get in touch with you if they need to.
Great. Thanks so much, Alexandra. It's always a pleasure seeing you and speaking to your audience, and look forward to next time.
Yeah, absolutely. Have a wonderful day.
You too. Bye.
Bye, everyone.